Let's start in alphabetical order. Jame from Georgetown University, who's had an illustrious career as a visiting economist at FINRA and other regulatory bodies. And also Caroline Hill, who's the Director of Global Policy Regulatory Strategy at Circle, who's the sponsor for one of the most successful stablecoins around, USDC. Oki Matsumoto, the CEO and Chairman of Monex Group. Oki has had an illustrious career at Salomon Brothers, Goldman Sachs, all the way to starting Monex with the help of Sony. And as you know, Monex is behind quite a lot of activities in Tokyo Stock Exchange and other major financial hubs in Asia. Lastly but not least, Hiromi Yamaoka, excuse me, Yamaoka from, Hiromi has had many roles to play as special advisors for international finance at Tokyo Metropolitan Government, chairperson of Digital Currency Forum, and a member of board at Future Corporations. My heartfelt thanks to all of my panelists for taking time and spending this afternoon with us. Looking forward to all the fantastic discussions we're going to have. And to start off, I'm going to start with Oki. Since you are in the thick of things as far as financial intermediation market goes, and has had a fantastic history on the TradFi of things, moving into the sort of the DeFi, could you give us a rundown of how this recent debacle of FTX collapse, BlockFi bankruptcy, and et cetera, reverberated in, the digital financial world, but perhaps even in the traditional one? Please.
Okay, thank you. So let me introduce very briefly, as Ali introduced me, I've been in this, I started my career in Salomon Brothers in 1987, right before the Black Monday. And I've been always trader. I've been in the market, fixed income, derivatives, all kind of things in Salomon Brothers and then Goldman Sachs. I was a trading partner at Goldman Sachs. And now I'm running this Monex group, including the traditional finance, equity online brokerage in Japan and also in the States, and also CoinCheck, the crypto exchange in Japan. In this 35 years career, I have seen many collapse, many blow up. Many things happen, and at the end it is always kind of coming from same reason. It's clearly the lack of internal controls. This time again on FTX, internal controls or corporate governance didn't really exist at all in FTX. So that is really the reason. Same as other blow-ups in history. But in case of this time around, one thing very unique is that there's no central bank in this field. In usual cases, when the financial institution going under, I mean, no companies or no financial institution goes under because of the balance sheet impairment, because of the low quality of balance sheet. It won't go under because of that. The institutions always go under because of the lack of liquidity. So the many institutions face the environment whereby it might go under, but central banks, time to time, provide liquidity to help or to somehow mitigate the shock. But in this crypto community, there is no central bank, or there's no one which provide the liquidity when it is needed. I think that is very unique to this community. And also, custodies are not divided, and custodies do not exist separately from the operating company. Usually, in case of Enron or whoever, if it's financial institution or non-financial institutions, they do keep money in the bank accounts. So away from the entity itself, there is a bank holding money as a custodian. But in case of this community, a custodian tend to be run by the same company. So that is a unique characteristics as well. So when things go bad, it goes just in a second. There is no stopping point. And also, lastly, I'd like to say, this time, I have to wonder if there was a fiduciary duty was exercised by investors. There is a very prominent, first-class venture capital or sovereign wealth fund were in big way an investor backing up FTX. And other people, if it's other investors or trade counterparties or customers, they see their names and feel, they are in, so this company should be fine. The problem was they did, at least as far as I see, they didn't do any fiduciary duty. They didn't send anyone to the board. They didn't try to create an advisory board. It seems to me they didn't do any due diligence. So that is really why this happened. This is kind of maybe because of the several years of too much of liquidity in the market. So people got somehow lazy or somehow, softened. But this lack of fiduciary duty, which is really away from FTX itself, but this lack of fiduciary duty kind of is the one, it's not unique to this community, but maybe it's unique to today. So that is another reason, I think. So those lack of internal controls, this is for everybody. No central bank, no custodians separated, that is unique to this community. And the fiduciary duty was not really exercised. This is unique to today. So these are kind of reasons why this happened, I think.
Thank you. Thank you. I think for our audience who will come from the tech side and the younger generations who don't remember the disasters of the past, I absolutely agree with you. The going down of Barings or the JP Morgan's whale, they're all examples of, we call them quote unquote rogue traders. But what it really is someone is in charge of a lot of transactions without anybody else knowing what's going on with those transactions. And this is the quintessential example of one guy running the whole show without anyone knows what the show is about and how it's done. To your point that it's always a crisis of liquidity. I mean, that's a fantastic point. You don't become insolvent. What you become is that you can't unload the asset at the speed and the price you want, which then in net against your liabilities is going to look really bad. And so if there is someone who can come in and step in and basically buy the assets at a speed and the price that is reasonable, we don't have a solvency crisis. Let me then come to you, Jim, since you've been on the regulatory side and one of the wiser voices of this space for some time. Some of this is stuff that you've been talking about for a long time, but kind of, I guess, piggybacking what Oki was saying, the crypto world has fought with regulation and regulators up until the time they needed them to come to their aid. And I've talked to some of the regulators, and their point today is, well, we're just going to let them alone to sort it out, which basically means it doesn't seem that they like to have the risk in their plate either. How do you see this, playing out? How do you see what's the next step is?
Well, there's an old French proverb which goes, the more things change, the more they stay the same. And the very reason why we regulate financial markets so thoroughly hasn't gone away. You know, we want to make sure that people aren't stealing money from our wallets, that they're not going to sell us fraudulent garbage. We want to make sure that the institutions that we trust aren't going to collapse. We want to make sure the economy doesn't collapse either. Now, those reasons aren't going away. So the public is always going to demand those kind of protections. So, you know, what we see with FTX is, as you've pointed out, a lot of things we've seen before. You know, misuse of funds. When people are holding on to other people's assets, well, temptation is always there to misuse them. And so one thing we can easily expect is that everyone is paying a lot more attention to custody. Where are the assets and how do we know they're safe? And indeed, in regulatory jurisdictions around the world in the TradFi sector, there are a lot of regulations which say you have to be very careful with your customer assets. In the US, we have this thing called Rule 15C3, the Customer Protection Rule, which says you must segregate customers' assets. Very strict rules. And these are coming in the crypto space. I know it's very popular in the crypto world to have everything totally decentralized, but that's more of a Platonic ideal rather than reality. Because when you look at most crypto ventures, there's usually some degree of centralization. There's somebody in that link you have to trust, whether it is the developer who wrote the software for your wallet, or whether it is an exchange acting like a broker. Yes, ideally, everybody will have their own keys, but a lot of people are going to have to delegate that because they will trust other people more than themselves to do the cybersecurity. So obviously, we're going to see more emphasis on custody. And indeed, you know, we saw this in the TradFi world. You know, the Madoff scandal indicated how loose the custody rules were in TradFi. And after Madoff, which was only 14 years ago, it was only then that registered investment advisors who were doing custody were subject to random inspections by the government to make sure the assets were really there.
Thank you. Thank you. So what I'm hearing from you is that when this whole thing started, 14, 15 years ago as a backlash towards the bank failures in 2008 crisis was perhaps misguided or misdirected. That is, maybe the root cause of the evil back then is something much more fundamental to the financial activity per se, but not the form with which the financial activity is performed. So with that, I'm going to come to you, Hiromi. Since you've been on the central bank side of things and side of things, how much of the financial history can be borrowed for the decentralized world? And what are the things that, irrespective of what you believe or what your preference or what your approach is, you still have to carry those principles with you as you perform financial activity?
Yeah, thank you. So I have long been working in the Japanese central bank, the Bank of Japan, and I have long been in the supervisory side or regulator side. Also, I'm now in the private sectors. I'd like to talk a little bit from the viewpoint of the regulators or supervisors. And I think that for the Japanese people, as Oki already mentioned, we experienced a bunch of things like Mount Gox in 2013. And in 2017, we Japanese already introduced the tight regulations on the segregation of the customer's asset in terms of crypto asset. So we try to introduce the best possible approaches for the decentralized finances. And it is also very difficult. As Oki mentioned, there's no central bank, so there's no guarantee for the providers of the liquidity in the market in the stress. We try to make our best effort to introduce the best possible regulation in the Japanese market. And for regulators, especially for regulators in Japan, the case of FTX is in some sense a deja vu for former incident. although its magnitude is substantially bigger than the old ones. And at the period of the former crypto asset bubble and burst in 2017, the CPMI of the BIS, as well as the Japanese regulators, intensively worked on the issues of crypto asset and decentralized finances, and its possible impact on the overall financial stability as well as the incumbent financial industries. From this viewpoint, we examined several points. Our major concerns are whether there is a credit contraction based on crypto assets, and whether there will be spillovers through credit contraction or liquidity shortage, liquidity problem, as Oki mentioned. And from this viewpoint, we checked several points. First, banks hold crypto assets, and if so, to what extent? And the second, do banks use crypto asset as collateral for making loans, or do companies borrow money by using crypto asset as a collateral? But at the juncture in 2017 or 2018, financial institutions' use of crypto assets are limited, so that we concluded that the impact on the decline in crypto asset prices on overall financial systems and incumbent financial industries would be limited. And one of my colleagues argued at that period, that it was simply like a fire burning banknotes, and that's all. But in the case of FTX, the regulators will examine similar aspects, that is, linkages between FTX and the financial institutions, linkage between centralized finance and decentralized finance, and through credit and liquidity. And although FTX may have substantial linkages with the players in crypto asset market, its linkage with traditional financial institutions seems to be still limited. But bankruptcy of BankFi implies that the situation is becoming a bit more complicated. And anyway, the regulator will have to continue examining this point, whether to what extent decentralized finance will be linked to the centralized finance, and will the credit contraction or liquidity shortage will make any spillovers also to the centralized world. And second, the regulators understand the fundamental incentive issues in crypto assets. Since crypto assets are no one's liabilities, stemming from the decentralized structure, if the issuers or exchange of the crypto asset fully safeguard the customer's money or asset, there will be no bankruptcy. And this is similar to the issues of narrow bank in economic theory. At the same time, easiest way in the decentralized finance to make profit is to safeguard only a part of the customer's money or asset and to utilize the rest of them as the fiduciary duty issues stemming from the decentralized structure. So that's the reason why Japanese regulators require the segregation of customers' assets. So also in the US, how to strengthen the regulation and specifically how to achieve the segregation of customers' assets and how to complete the fiduciary duty in the decentralized world become a more imminent issue in the future. Thank you very much.
Thank you. So that's very interesting. When I teach the class on banking and blockchain, I use the example, and this year I'm actually going to have him read the book on John Law, the story of John Law in France. He was a very colorful character, as you very well know. He essentially ran a central bank, a treasury, and the greatest IPO ever done, Mississippi Company. And since he could basically borrow for the money that then he would use to buy the assets, pretty much like FTX, he was running a hedge fund on the side with the money that you entrusted him to basically keep it in a safe deposit bank, so to speak. So I think there are a lot of parodies between very old finance and what's created here new. That is, lessons we learned 300, 400, 500 years ago are still true today. And as you guys said, you need to segregate the accounts. You need to make sure If I'm giving you money just for you to be the custodian, then all you can do with that money is to be the custodian. That's all it is. Now, there might be a cost for it, and that cost might be high, but that's your role. You need to be the custody. If you want to run a hedge fund on the side of it, that's okay. That's your money, but it has to be siloed away from my money, and you can do whatever you want with it. The funny thing is that in TradFi, and there's been quite a few examples of them, that the lines get blurred and people, start moving things around, and sometimes, innocently, most of the time not so innocently, they pretend to be innocent. Do you think that the fact that the technology and the decentralized ledgers have the ability to open up the black boxes and open up the information to be audited, at least in theory, more effectively? In fact, those promises, those capabilities are the ones that haven't been used, whether intentionally or unintentionally. I'm not going to touch on that, but it's a missed opportunity. That is, it's a technology that could solve actually our millennia-long problems. They just choose not to do it out of convenience or what have you. Jim, what's your take on that?
Well, I like the idea of using technology to solve the problems. The real question is, I think we can go a long way for solving problems. So, for example, if you look at stations that are actually audited, or I should say audits that are actually credible, unlike with some of the other so-called stable coins out there, those are areas where technology can come in, especially with the transparency of a blockchain. But in other areas, we run into a collision with privacy, in that we'd love to know that a bank that is making loans is safe, but at what level of information are we, the consumers, going to be able to see on all of a bank's loans? So there's a lot of confidential data there that people, for good reason, don't want to see made public, and I think that's going to get into the problem. So we definitely have this collision between the desire for data transparency and the desire for privacy.
Thank you. So that's a very interesting point, because now I can segue to our resident stablecoin expert, Caroline Hill. The way I understand it, and you can correct me, your firm works is that the accounts that are KYC, AML, OK, are opened in traditional sort of a finance side, and then against that, the stable coins are then minted for the clients, and the reverse can also be true. So in that respect, I guess the verification of the assets and the custody features can be done relatively more effectively, I'd assume. But at the same time, what Jim was talking about, which is maintaining anonymity and the privacy and the secrecy of what I want to do with my money, et cetera, it's also afforded to the client. To what extent? Where is the happy marriage? Where is the boundary where we can have our cake and eat it? And is there such a thing, or am I just being naive here?
Well, I think that we can definitely have at least some of the icing. Whether we can have the entire cake and eat it too remains to be seen. But definitely we need to be aware of the fact that there's a limit to how far we can go with complete transparency. And there's a limit to how far we can go with decentralization. And I think there's probably I
think Jim got frozen again.
An impossibility proof here that borrow Bitcoin. I was about to say, I think there's an impossibility theorem lurking here, that as long as people are willing to pay positive interest to borrow anything, you're going to have some kind of fractional reserve banking pop up. And that means you can't have perfect decentralization, because any kind of lending protocol has some degree of centralization. Even if it is in a smart contract, that contract itself becomes a point where you worry about custody and you worry about solvency.
I guess same question to Caroline. What's your take on it?
Yeah, absolutely. I like the thought of having the icing, but I think right now we're actually designing that cake of having the privacy and still having the illicit finance side. And I think that was really pushed into view. I think many in the industry have been thinking about privacy and how to preserve privacy on chain for many years. And we've also been thinking about illicit finance for many years. In fact, it was some of the first regulations imposed on digital assets in the United States and worldwide was on illicit finance side. But I think it's really been pushed into the conversation every day, as evidenced by today, given Treasury's sanctions on the Mixer Tornado Cash earlier this year. I think the solutions or the what we have seen thus far in trying to maintain our users' privacy is still evolving. And I think that we have not seen kind of the end-all be-all solution yet for what that looks like. But I think many in the industry are trying to explore, zero-knowledge proofs and other types of privacy coins in order to maintain that privacy while still adhering to some type of financial crimes compliance. I think we can all agree that governments around the world are not going to compromise on the illicit finance aspects, but we also shouldn't be compromising on an individual's right to privacy. I mean, that is obviously something that Americans and citizens worldwide take very seriously.
Thank you. So I'm gonna segue to something that is near and dear to me, and I don't. Hopefully, I have some sort of a sympathetic audience here, but to me, one of the fundamental flaws, so to speak, of the viewpoint of the DeFi is that it has no appreciation for the role of maturity transformation in financial systems. Majority of the money that is used in the world is used for that very purpose. You take a very fast-moving, paycheck and turn it into a multi-year car loan, decade-long, home loan. Much longer than that, industrial loans, et cetera, et cetera. And it collapses an economy if we allow depositors to be the source of unwanted, unforeseen shock that, we have to sell the house because the depositor wants his money. I mean, there's no security. You have no security for shelter, for economic activity, et cetera, et cetera. Hiromi, I guess this is a question for you since you've been on the thick of things on this. How would, if ever, and I hope that there is a solution for it, DeFi can basically offer the very services that we have all grown to appreciate, live with, and can't live without, that TradFi offers, where it's sort of a highest speed, tendency, this forced liquidation, things go wrong, just sell everything. That kind of feature it's antithesis to what finance is actually about.
Okay, yes, for the former question, you raised a very important point for the, subtep or regtep. We discussed on those issues for a couple of years, subtech or regtech, how the blockchain or DLT would, enhance the efficiency of the regulation itself. It's a very important issue for the regulators for a couple of years. And of course, the blockchain or DLT will be a very promising technology to enhance the efficiency of the regulation itself. For example, in a centralized structure, it's quite easy to apply the regulation. What we have to do is to define who is a financial institution and to apply the banking regulation or financial regulation to them. That's simple. We limit the scope of regulation. But in a decentralized structure, it's quite difficult to apply the regulation on entities. That's the fundamental issues for the regulators.
Oh, you get muted.
Sorry, which muted. Sorry. So, and blockchain or DLT will give a very promising technology because in a subtech or regtech world, the regulators or supervisor could be one of the nodes of the blockchain and DLT and obtain the information or data simultaneously with the traders or market participants. So the DLT or blockchain would be a necessary, very necessary and promising technology. And for the, your immediate question on the structure of the decentralized finance, There's a fundamental issues. But for example, in the US, there's also, you have a history in the 19th century of the decentralized financing. That is the wildcat banks. And that period, the wildcat bank was operating without having central banks or without having Federal Reserve. As you know, that the Federal Reserve was established in 1913 after the collapse of the wildcat banks. And at that period, wildcat banks operate or issue the payment instrument widely to the general public without having a central banks. That's why we needed bank regulation and deposit insurance afterwards. So if we look at the current situation of the decentralized finance, if, for example, someone issues a stable coin without 100% reserves, that is similar to commercial banks. So we need to apply the commercial banking regulation. So if we look at the current situation, in my guess, the global regulation on the crypto asset or cryptocurrency would converge to the existing banking regulation, the structure of the banking regulation, which has been established through the human history and many incidents in the human history. That is my view. Thank you very much.
Of course. Well, I guess I'm going to come back to you, Oki. Let's envision a future. In this future, I think, at least I'm of that belief, that stable coins and perhaps CBDCs in a different way, the digital money has a very real use case for a variety of reasons. If we are going to build that future, are there tenets that we need to agree on in generalities, and then holding ourselves to that true, then we go and do our own experiments. If so, what are those rules? What are the basic principles that we need to live by?
I think having outsiders' eyes are crucially important. Whatever we do, if it's technology, regulation, blah, 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 whatever we do, if the operation is done by one man, anything could happen, right? So it is essentially important to bring outsiders' eyes into those, system or company. So in case of FTX, there's no outsider's eyes, right? So even we come up with a regulation. Well, if the entity is run by one person or just one family or whatever, without outsider's eyes, it can disguise anything, right? So bringing into making sure there is outsiders on the board or in the company or somehow, that is really, really, really important. And that's been always the case in history, and it is going to be the case going forward as well. And also, this is not really the regulation or rules, but for people to make sure to have healthy skepticism is always important. I'm from investment trading business, right? And there have been always many interesting investment opportunities. And then there are some people who got, screwed. There are some people who kind of navigate avoiding those, the incidents. The latter ones, they have a healthy skepticism. And that is always very important.
All right. So what I'm hearing is that the old-fashioned finance, rules of diversify, never put all your money in one bet. All the oldest stuff is always true. You should never do anything against that. The only problem is this. I feel, and I could be wrong, very easily wrong, but I feel that there is an unhealthy appreciation, maybe a love, for those who are successful, especially money-wise. And it creates a blindness. People equate someone who went from zero to $60 billion as a god, and all deities deserve worship. It goes against our nature as human beings not to behave that way. And I feel that part of a role of a regulator is to be the voice of reason, which we have a tendency to ignore when we are, in love with whatever we are in love with. And perhaps in a place like this, where there is no regulation, it's only evolution that is going to take care of it. The bad actors, the wrong models, the wrong rules would cause a lot of pain, but they go away, and whoever is left is going to be the role model. So with that, I'm going to come back to you, Caroline, because you've been one of the role models in your world in the stable coins. What are the things that in your world you have found valuable coming from a TradFi sort of a perspective, from Treasury of all places? What are the things that you hold true, your organization follows, that gives you the ability to basically stand behind the credibility that you want to sort of pose to the world?
I'm so glad you asked. This is a great question. And okay, I agree with so much of you said about needing outside regulators looking in. I mean, all the industry has had up until this point is trust and accountability, because we don't have those regulations ensuring that people are doing what they say they're doing. And Ali, to your point, I think FTX is demonstrative of the fact that when you put too much trust in one person and a personality, it is really a cult of a personality. We've seen, billions lost. We had a not dissimilar effect with Do Kwon and Terra Luna earlier this year. Though I think, frankly, that was a little easier to predict ahead of time. And so, at Circle, we take that trust and transparency incredibly seriously, which is why we put our reserves on our website weekly. We have Grant Thornton attest to them monthly. We have yearly audits. We obviously are going public, so we have SEC filings. But we take that trust and transparency seriously, because that's all the industry has right now. We don't have a regulator saying Circle or another stablecoin issuer or this exchange is doing everything that we say they should be doing. And so, I think right now we had a hearing this morning in the United States on FTX with the CFTC chairman. And I think right now the United States government is in a position of, well, what exactly happened? And hopefully soon we'll get to what needs to happen now, because obviously that's the more important part. But I'm hopeful and optimistic that we'll see regulation that protects the consumers while still allowing firms to innovate and really take the advantages of this, of the digitization of money, which I think, we're all in agreement has incredible potential and could really, revolutionize the future of finance as we know it.
Thank you. Well, it's been great. I think it's time for the audience questions. You think 10 minutes? All right. Well, I guess I'm going to do my loaded questions. So here we go.
Well, actually, can I jump in with a comment?
Yeah.
Okay. I want to dispute the notion that we have no regulation. What we have is bad regulation. That what we have is either a mess like we have in the United States with literally hundreds of regulatory agencies, including state money transmitter regulation, or at the other extreme in a place like Bahamas, where their digital act, their DARE Act as they call it, has these nice flowery principles, but there was no enforcement. Okay, so yeah, we have plenty of regulations. We just have very bad implementation of that. But I wanted to agree with what Hiromi said about, we have all this experience with bank regulation, which is very important, and I think we do need to apply it to the Tethers of the world. But also I'd like to make the point that different technology also can require different regulation. That requiring exactly the same process that we require for a TradFi operation is not necessarily optimal for DeFi operations. So we need to really appreciate the differences as we figure out how to apply our regulatory needs into this space?
I think that's well said. We have been applying decades-old regulation to technology that is brand new, and agreed, we do have regulation. It's bad here in the United States, and it was putting, I think, a round peg in a square hole when digital assets came onto the scene and states said, okay, we'll apply for a money transmission license. But the lack of a harmonized federal framework that really takes into account the risk from this technology, and you're right, we say same risk, same regulatory outcome. Some people say same risk, same regulations. I think same regulatory outcome, where we have further, again, customer protection and fiduciary requirements that fit this space.
Mhm.
I'd like to say one thing is that good outside director can be much better than any good or bad or whatever regulators,
Mhm.
right? So it's not only regulation, to implement the internal outsider kind of point of view is really important, I think.
Could I jump in? Yeah, Oki and Carol. Yeah, sorry. So Oki and Caroline mentioned the very important things. It's incentive issues in terms of the money and the currency. And actually, the money and the currency has one of the very critical characteristics. The issuer could get the benefit. So that's why the government will have always incentives to overly issue the currencies. Always. That's why we needed a central bank outside of the government. So how to say the enhance the incentives to see each other to achieve best possible balances in terms of currency is a very important point, as Oki and Caroline mentioned. Thank you.
Well, thank you. And look, if I may summarize, I think even the theme of our morning discussions is that the experimentation up to this point has been trying to do the TradFi fast and furious, so to speak. And it seems like we are at the moment that we may lose the opportunity to explore the real potential of decentralized technologies. We could definitely do things faster, but that doesn't mean we should do them the same way, just faster. We could do them differently. To me, one of the things that I love philosophically about this space is that it allows for individual voice to be heard. We don't need representation in order to be heard. And the representation could be elected official, could be appointed official, like a regulator, et cetera, et cetera. If I'm doing something and I want to voice, what problems I see and how I want it to happen, a decentralized framework would more effectively allows for it. And if we buy into that premise, then it seems like we are missing a fantastic opportunity to change fundamentally how we create consensus, create governance structures, et cetera, et cetera. And perhaps that's a frontier to be explored. So I'm going to leave that to hang in there, as a ticking time bomb, and I'm going to open the floor for questions from our audience. We have one right here.
What do you believe the impact of central bank digital currency reserve stablecoins will have on the decentralized finance ecosystem? Open question to everyone, on anyone.
I think that's assuming we have CBDCs.
If 70% of central banks around the world are looking at CBDCs, I think we have a very good, at least one of those will go through, you would hope at least. But open question, what do you believe would be the impact, hypothetically?
Well, I've been a proponent of central bank digital currencies for many years. In 2014, I was quoted as saying the US Fed should come out with the US dollar as the central bank digital currency. And I've long predicted that it would push aside private monies, because when you look at the history of money, that's what governments do. that because money as a social construct is so vital to the economy and the power of the government, governments like to control it. And, and so this is what we see happening. I definitely see CBDCs, pushing aside private monies. Now, what we'll see in the DeFi sector is, I think that, they'll be making good use of CBDCs. But I think what's really exciting is the massive experimentation we're doing with rethinking how we deliver financial services. And I wanted to just echo what Ali had said about how we don't want to lose this opportunity to find ways of doing things better than we've always done it in the past. And I think that's a very important thing to think about.
One challenge we have is that nations do not pay interest on paper bill, but if it's CBDC, people may start asking interest to be paid on the CBDC. That is going to be huge cost for the nation. So that's how I believe, of course, CBDC has got lots of more opportunity, more functionality, and just great. But there is that kind of very pragmatic problem or challenge exists, I think.
Yeah, actually, there's a bunch of debate in academia whether we should issue we should provide the interest on the CBDC. There's a bunch of issues, and some academia supports the idea of providing the interest or impose a negative interest rate on the CBDC. But practitioners in the central bank will not take this kind of ideas. Central bank argued that if they issue the CBDC, there would be no interest at all because the sovereign currency is a nominal anchor for the transactions. So it is quite important to maintain the stable nominal value for the CBDC. That's why in general, the central bank in the world do not have this kind of idea of providing the interest rate on the CBDC, in my understanding. Thank you.
Thank you for your answers. The question was specifically around a central bank digital currency reserved stablecoin. Central bank digital currencies, as opposed to the side, we have fiat-based stablecoins, we have cryptographic-based stablecoins, we have algorithmic-based stablecoins. Having that new section of stablecoin, which is reserved by a CBDC, is the question. How would a central bank digital currency reserve a stablecoin? How that stablecoin impact decentralized finance? Just to be very accurate with the question.
Okay, can I ask one question to John? Thank you for joining that today. And so I saw that newspaper advertisement of Trust Us from the Coinbase. And so could you explain that? So how my grandmother can trust Coinbase?
Well, first of all, thank you very much for inviting me to participate. I hope I'm coming through. There's a little bit of echo on this mic that I'm using. There's obviously a lot that has transpired since FTX, and it's still playing out as we speak, and a lot to be addressed. In fact, so one of the things that's incumbent on us, on everybody who are part of the industry, is we do need to build trust and rebuild the trust, not just with the regulatory community, but with our customers. And we can do that in a number of ways, and trying to be as transparent and try to be as open as possible. I think for us at Coinbase, at least, we've been very clear that we've called for a comprehensive regulatory environment or framework that we can use to rely on in these type of times, and make sure that everyone understands the rules of the road as clearly as possible to prevent these type of events. I think we look forward to the Indian government's commitment as part of their G20 presidency to address some of these concerns and really bring out, prioritize trying to bring together a comprehensive global approach to the regulatory construct that we will need for the industry to continue to grow, for innovation to continue, and for us to continue to gain and rebuild trust within users, and to make sure that the next stage, the next evolution is there for everyone to be able to benefit and securely participate in. So I think there's a lot of opportunity for all of us working together to be able to bring that in the next, in the next period, the next 3 months, 6 months, the next year. I think that's very important for us, not just to do it as individual voices, but collectively as people who are part of this ecosystem and who care about its continued development. So thank you.
Well, so if I may follow up with that, we have a question online, which I think relates to that in a different way, but closely. So the question is, by nature, crypto will not ask for a central bank to exist. I guess in such a world, should we consider the collaborated liquidity pool? If that's not possible, then should we consider a world without the liquidity supports? How? It's a broad question, pretty loaded for that matter. But I think it's conceptually, it's a great intellectual exercise. So if any of you guys want to take a stab at it, go right ahead.
Well, there's been a long debate in monetary circles about fractional reserve banking and even the existence of central banks. And there are a lot of people who hate the idea of a central bank because the magic power of a central bank is the fact that it can create fiat money at the stroke of a pen. And this has proven to be very useful in financial crises. As long as you have any kind of borrowing and lending, you'll have liquidity crises. And having an entity that can conjure up liquidity at that time is essential for protecting the economy. So if you got rid of that, you'd also have to have an economy without borrowing and lending. And that would be an economy that loses a lot of the benefits of financial services. So I may be old-fashioned, but I like the idea of having central banks. I like the idea that there is a backstop there for our financial system. And the thought of having a financial system with no backstop is one that I find pretty scary. And the idea that you can have a pool backing it, yes, but that pool is still not going to be able to create liquidity out of thin air. So
that's a very fantastic idea. I mean, when I teach banking, I tell the kids, there was a post-industrial revolution. There was half of it that there was no central bank in this country, and every 10 years there was a depression. And I don't mean a recession. I mean a depression every 10 years. And the moment we created central bank, depressions went away. The only thing we have is recession. Sometimes bad, sometimes not. But what you have is that you don't have a total collapse of economy that you have to rebuild again every decade. So there is absolutely proof in the pudding of what the role of a central bank is. I think most kids or the puritanical ones think that central banks are a source of inflation. The thing of it is that inflation is not such a bad thing as you think of it. It's a hyperinflation that kills you. You actually need inflation because deflation is the devil you never want to live with. And if you don't trust me, you can ask our Japanese friends what deflation feels like. But with that, I guess I'm gonna come back to the last questions for you guys, which is to make things a little bit liven up and happy before we move on. What's next? What are the new frontiers? What can we get excited about as we look for the next 5 years? Not just investment, employment opportunities, the startup opportunities, whatever have you. Where do you think are the great unknowns that we could make billions, maybe trillions?
Oh, I wish I knew the answer to that one. Well, clearly there's going to be a bull market in regulation that, so in the RegTech side, applying all of these tools to this area, I think there'll be a lot of jobs there. That's kind of the low-hanging fruit. What the next unicorn creating fantastic breakthrough is going to be? Well, if I knew that,
you wouldn't be here.
yeah.
John? You're still mute.
Mute.
Sorry, is that better? I'm
Yeah.
having a little bit of connection problems. Yeah, sorry about that. Look, I think I agree with all the comments that we've heard so far today. I mean, you know, the coming wave of regulation is something that we'll have to deal with. It's something that what I'm hoping for is that we can find ways to work together with the regulatory community to find answers that work, to make sure that, you know, that we continue to foster the innovation and the spirit that's currently in the ecosystem. So I'm hopeful that in all the conversations we're having to date, even post FTX, that people still seem to want to listen and want to work together to develop this type of appropriate regulatory framework.
Any concluding remarks?
I'm hopeful for that too. I mean, I think at a more basic level, we are really moving from the, you know, dial-up phase right now into the utility phase. And I think in 5 years, we won't be touting the examples of how this makes cross-border payments easier and things like that, because digital assets will be more part of our everyday payments life. And I think that will be a massive improvement on the financial rails that we have now. Now that's 5 years. I don't know where things will be 15 years. I'm really hopeful about the future of privacy as well. And I think that's more in the near term. But I think soon we'll be sending money like we send emails, and it'll be quite easy, fast, and cheap.
Yeah, just one thing. The central bank provides liquidity in case of emergency to banking industry. On the other hand, the central bank asks the banking industry to deposit a partial reserves to the central banks and impose a supervision. So we need to take a balance between the liquidity provision and the duties for taking a liquidity provision. How to strike the balance between those two things is the important issues in the future. The coming 5 years, there would be more and more overlaps in terms of payment instrument, in terms of the decentralized world and the central world. There would be more and more overlaps. And the DLD and blockchain, the promising technology, those technology will be used for more variety of usages. Like as Caroline mentioned, the cross-border payment, a cross-border transaction, or a variety of assets in the coming 5 years. This is my view. Thank you.
Well, thank you all. This has been a fantastic conversation. Thank you for your thoughts and your time, and spending this afternoon with us. Thank you. Yes. So without further ado, I'm going to start our next panel discussions on decentralized treasuries, DAOs, and their applications. I've got a fantastic panel with me, Caroline Hill from Circle, Director of Global Policy and Regulatory Strategy. Judy Bogle is a partner at BLG, the major law firm here in Canada. Judy has been in charge of corporate governance, merger acquisitions, and she's also a member of the firm's digital asset group. And lastly, but not least, an alum of UBC and the CEO of a new startup, TeleportDAO, Niusha Moshrefi, whose firm is dedicated to solve the interoperability challenges of blockchains across various protocols. Ladies, Maharfa, thanks for spending time with us this afternoon. And let me just get to it. So obviously, we want to spend some time understanding some of the, I guess, frontier questions of DeFi as we're moving, hopefully, past this winter, or as I call it, nuclear winter. So I'm going to start with you, Caroline, as our bona fide stablecoin expert. from a broader spectrum of activities. It seems like even the other day I heard that some of the people at the Fed are thinking about letting go of pursuing a CBDC at the Fed and just having stable coins be the digital money. And this is, that doesn't necessarily surprise me. When MasterCard and Visa started, Fed didn't start issuing their own cards. It let it happen. Or they didn't fight with PayPal or other online payment systems. So if that ever happens, to me that's not entirely surprising. But let's assume for a second that that would happen. If so, what are the great frontiers in decentralized world where stablecoins can play a role and people can play off of the stablecoins to develop business models, et cetera, et cetera? So if you could start us with those ideas, Caroline.
Sorry about that. Yeah, absolutely. And thanks for allowing me to join today. I think we have, I think what technically the title of our panel today is Decentralized Treasuries, DAOs, and their Applications. So I spent some time thinking about the evolution of DAOs, really starting as funding startups, as a collective, and really trying to democratize financial services. And I think we've seen really interesting use cases come out of that. Constitution DAO, raising 40 million to buy the Constitution, Pleaser DAO, trying to buy digital art. And I think those purposes, coupled with the technology that we've seen with smart contracts and decentralized treasuries, will really allow corporations to organize capital on chain in a more productive, streamlined manner in the future. I think with that comes challenges, or we've seen challenges around prudential treasury management. Certainly, we see that when companies or when DAOs are deciding how to manage their treasuries, when to buy, when to sell. Certainly, there's conflicts of interest that we've seen when they have proprietary tokens. And we've seen that around custody and control of that as well. And I think the other kind of interesting phenomenon that we've seen recently is this kind of I would say hedge fund effect of decentralized treasuries. We've seen that effect of companies of DAOs trying to make up for losses of treasuries or invest their treasuries in productive and more fruitful investments. And I think that is, of course, risky, but it's certainly paid off for some, and we'll probably see more of that in the future.
Thank you. So, I'm a segue, but I got to build a little story before I can segue. So one of the, I guess, puzzles that I really love to see how DeFi can solve is a prototypical mortgage payments. When you pay your mortgage, you just write one check and you're done. But the tricky thing about it is that it has multiple components. That one check basically pays the bank, which in of itself has two parts. And from perspective of securitization and the bondholders that are actually have to receive, that it creates a whole domino effect right there. Part of it is repayment of the loan or the principal. The other part is the interest, and there are the various securities that tap into those two. Part of it is insurance payment for your house, and part of it is taxes. You can imagine that basically that one payment is talking to at least 5 different systems, 5 different networks, perhaps even more. And each one, for various reasons, demands a certain level of verification and identity sort of a revelation, if you will. If I'm dealing with the tax authority, I want my identity 100% to be revealed, because at the end of the year, I don't want IRS to come knocking on my door that, where's your taxes? I already paid it, but if they have had some difficulty, technology or otherwise, recognizing that I was the one who paid it, then, I'm on the hook for something that I already did. So obviously, interoperability in a very broad sense plays out even in, a simple example like that. So I'm going to ask this question from Niusha, since you are working in interoperability. What are the, I guess, current challenges that you see, and specifically your firm is trying to solve to make networks talk to each other?
Yeah, yeah, definitely. Let me start from the beginning. So exactly as you mentioned, so let's see why blockchains emerged in the first place. So blockchain wants to solve this problem of trusting a third party. And if someone's using blockchain, if someone using a token on some blockchain cryptocurrencies, they are using that because they want to remove this trust from like third parties. And if they want to use this, if they want to use some applications, and in that process, they need to go through a centralized entity that is not transparent, that does not like comply with this main goal of being trustless. So that defeats the whole purpose. And that's why it's important to make the interoperability of blockchains and this connection to be more decentralized and more trustless. So I believe that the main problem that now interoperability is facing is centralization. And you can see that there are some problems, there are some solutions to solve this problem, but they tackled it in a centralized way. And I think that might that might not be like the best thing for users. As you can see, for example, the recent thing that happened with FTX. So they had issued some wrapped Bitcoins on Solana so that people who hold Bitcoin could use their tokens in some other ecosystem, which is Solana. And users who use that token had trusted FTX that they have some Bitcoin in their reserves backing those wrapped BTCs. But it turned out that they didn't have that reserve, like they had 0 Bitcoins, and that was why the value of the wrapped Bitcoins went to 0 overnight. That's what is the main concern now, like trusting a centralized entity that is not transparent to do the interoperability, to wrap tokens, to like manage some cross-chain or multi-chain applications. And I believe that like this issue can be solved in 2 main ways. So for example, users can choose to go with decentralized entities, but these entities need to be more transparent, need to be fully regulated, and they need to know like what's actually happening there. Or users can go with some decentralized solutions like Teleport, that everything is trustless, everything is done by the code, so everyone can go see the code that is public on the blockchain, and everything will be done by that code. So they don't need to trust any third parties. That's our main focus in Teleport, to make this interoperability between layer 1s, layer 2 different blockchains to be trustless and decentralized.
Thank you. Thank you. I guess in order to segue to my next question is, I come from Wyoming. We were one of the first jurisdictions that defined DAOs as legal entities. So you can have a DAO LLC and whatnot. And happy to say that, people around the world, some places think that, our models seem to be pretty good. But beside, doing a plug for Wyoming, the point I'm getting at is that I feel like up until at least a year or 2 ago, there was this naivete sort of feeling that since we're doing things with code and decentralized, blah, 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 we're immune or isolated from needing any legal sort of a definition, et cetera, et cetera. And of course, as always the case, nobody likes lawyers until they need them. So as the resident lawyer, Julie, this is the question to you, that what are the legal issues? Looking across the board, various jurisdictions, various rules, et cetera. What are the major things that DAOs need to have in place in order to be legally protected from what could come at them and come at their founders and members, et cetera, et cetera?
And well, thank you for having me. To start off, one thing that's hard to, when you're asking a lawyer a question like this is that we are only able to give advice within our jurisdiction. So my jurisdiction is BC within Canada. And I think that's one thing I often struggle with when I help clients in this sector, where they come to me and they say, my competitor is doing X, I want to do it too. How do I make it happen? And then I say, okay, well, your competitor isn't operating, it's not a Canadian entity. It doesn't have any Canadian customers. Canadian law likely doesn't apply to it. So what it's doing is irrelevant of what you can or cannot do, or what rules you have to follow to do what you want to do. And I think I really struggle with this industry in particular because it is such a global industry where people aren't really focusing on where their customers necessarily are located, because it's all, you know, in a virtual world, so to speak. And then that's further complicated by the fact that we don't have consistent rules across the globe in terms of how to manage this industry. So in Canada, just to give like a bit of a baseline before I go into your specific question on DAOs, because I just think it's helpful to kind of have that common understanding. So in Canada, I think that we are a bit of a leader in terms of what our regulation is and the clarity of our regulation within a certain scope. So what's happened is we have, in part in response to Quadriga that happened in our backyard, we focused on regulating what we call crypto asset trading platforms, which most people call exchanges. So there's some clarity in terms of what rules you have to follow or what exemptions you need. And eventually with the goal of those exchanges becoming IROC dealers, the same as like any investment bank is registered. So there's a lot of understanding there. And then because there's already this regulatory framework with a lot of the players already interacting with regulators on a regular basis, as new products come online, regulators are working with the companies to regulate them. So for instance, there's like a new wave of permitting staking on Canadian exchanges. So it's actually a regulated activity by regulated entities. And that's not to say that every entity is regulated, but they're all supposed to be in the queue, or they're kind of getting notices and letters, cease and desist, and some of them just can't operate like within Ontario specifically. So that's like a bit of a background on the crypto community regulations in Canada, but there is no clarity on DAOs. There's no specific clarity on some types of products. And so before we can kind of dive into those challenges, you just need to understand that if you are operating a DAO that is with members in Canada or with customers in Canada, you don't have a specific set of rules or guidelines to fall within. As you were saying, you do more so have in Wyoming. So then in terms of what some challenges are, I want to pick up on something that Oki said in the last session, which is the fiduciary duty. That's a big challenge that DAOs have. Who has that obligation? Who has that fiduciary duty to act in the best interest of the DAO? And from that, another thing that also flows has to do with corporate governance, or in this case, community governance. And how do you manage that when it's inefficient at best because you don't have high participation levels, and it's hard for those members to be fully informed and make those educated governance decisions. And then even if it is a DAO that's, for instance, registered within Tennessee, let's say, it might be hard for that DAO to comply with the rules that it's regulated to comply with. So I believe in Tennessee, and again, I am not a lawyer in the States, but I believe in Tennessee, you have to have like a simple majority of members to vote on a governance change. Is it realistic that your DAO is going to actually get 50% plus one of members to actually vote on a change and have them be informed in that vote? From a corporate perspective, that is not a threshold that most companies are able to meet. So that's something to really think about. And I think another thing to think about is let's say, let's say you're operating a DAO, you're not within a specific confines. How do you ensure that you're not inadvertently creating a partnership? And in turn, how do you ensure that you're not inadvertently having liability for obligations that that DAO has created flow to each individual member on a proportionate basis? And if it does flow to each individual member on a proportionate basis, is that really a vehicle that a third party is going to want to interact with? So I think DAOs, and I'll get into this a little bit later, but like I think DAOs have very much a place, but it really depends on its use case, and it really depends on where it's going to operate. And the other thing that you always have to think about is the tax implications. And again, that flow through the tax implications on individual members if you don't have a legally recognizable entity to kind of protect the membership.
Thank you. I'm going to put something here that is unbelievably loaded, but I'm going to do it anyways. I think there is a threat that comes through, obviously, the unhappiness with 2008 crisis and whatnot. But there's also another threat that I think comes through the fact that there are a whole lot of kids on the techie side of things that went about, presenting their cases in front of incubators, et cetera, they didn't get funded. So they decided, well, I'm going to create my own money. That kind of attitude, I think, reverberates. It's not just I'm going to create my own money. I'm going to create my own law. I'm going to create my own organization. I'm going to create my own business, et cetera, my own world for that matter. And maybe they will be successful. I have no doubt, probably beyond my years. The thing of it is this. While we are doing this transition, we still have laws of the land. We still have infrastructures, regulations, things that we've been doing. How much of our existing structures, governance, legal, et cetera, is going to be impediments for the transition? And since your generation is going to be the ones that are going to do it, what are the things that you like to see bust through and get rid of in order to create that brave new world? And I'm going to start with Caroline, since.
It's a great question. Frankly, as you were asking it, I was like, well, that is really looking into your crystal ball. And to hearken to our last conversation on the last panel, I think a lot of it will be determined by how regulators determine the future of it, and if they kind of get there first, or if industry is more successful in educating and saying, this is the regulations that we want for DAOs. Julie, I thought you highlighted a really important point at the start of your comments, which is we're not even working from the same taxonomy yet, region by region, country by country, which makes these conversations really challenging, particularly between governments who I think have some incentive and some desire to harmonize those standards. But I think, we have seen joint stock corporations around since the early 1600s, and not a lot has changed since then. So I understand why I think the industry is trying to turn that on its head and see how we can figure out a more democratized way for the future.
Julie, from a legal perspective, what should change? What does the evolution path looks like?
Well, it's been really interesting watching regulators try to adapt, especially when they have an incentive to put something in place, put some rules in place to ensure that there's good actors and that they're protecting the retail community at the end of the day. So, I can think of a couple of examples, both in terms of ICOs and in terms of how they're now regulating kind of IROC dealers or the exchanges, where regulators are really trying to use the tools that are already in their toolkit and apply them to this new and emerging area. And sometimes it works and sometimes it doesn't. And I think one of the issues, so for instance, on the how to regulate the exchanges, one thing that's really hard is that there's kind of new products. Custody looks different. And the fact that there's new products coming online all the time. So it's not always as easy as just applying the current rules to this new industry. Sometimes there's more nuance to it. But in other cases, like the ICO, I mean, I think it makes a lot of sense that you regulate a token that's used to fundraise in the same way that you would regulate a share that is used to fundraise. Like, there's a lot more analogies there. On the other hand, I can see why people were frustrated with the rules around fundraising, because although their intention and their policy purpose is to protect the retail market, it can inhibit innovation, and it can inhibit investors from being able to really participate and support new ideas that they want to see come forward until they're at this high net worth individual level, where at that point, I don't know, it kind of disenfranchises things. And regulators are trying to address that by like putting new crowdfunding rules in place and taking action to regulate things differently, but they haven't quite got it right yet. But it's not that they haven't got it right yet for this industry. It's like, it's just a complicated problem in general with that policy implication of, or that policy goal of protecting retail market. So I guess, what do I want to see the world, or where do I want to see go from this? I think I love this industry because new products are constantly coming out, because they're constantly pushing the edge, and it's literally a new conversation every year. And yes, there's some threads that flow through, but I like that this constantly is pushing things forward, but I don't really know what's going to stick for the long term.
And lastly, Niusha, from a technological perspective, how much do you think the sort of old-fashioned databases talk to each other? You know, there's a technological bias that still anchors people, that they can't sort of see, well, forget that, I can recreate and think about problems in a completely new way that is a source of all challenges, or some of them, most of them.
Yeah, that's actually a very good question. So from technical aspects, I can say that, so everything started with Bitcoin, which was just a peer-to-peer payment system. And it continued and it became decentralized finance. We have Ethereum, we have many applications that like changed how we see finance and made it decentralized. We have many applications in that area. But what I think is very important is to like go one step further in future and like have more applications on different areas other than finance. So there are some examples. There are many projects working on this stuff. For example, we now have decentralized and distributed storage systems. We have distributed and decentralized streamings, I don't know, like network providers, and many other applications that you can see. And I think in like from the technical aspects, like we have this technology, and like many great teams are working on that. But another very important thing here is timing. So for example, we've had some great projects working on DAOs, and they probably excelled it in like many aspects. They have like a great technical innovations that they have, and they have solved many problems that should have been solved, but the timing was not right. So they didn't really like make that much difference. But in future, I believe that we'll see more of those projects solving much more creative problems, and even in some cases creating something that didn't exist before. For example, there is like a concept like let's say flash loans that just I believe that it just exists in blockchains. It didn't exist before, or like many other stuff that can be created in this whole new world that is like growing. So yeah, I believe that, and also there are many different scientific findings that maybe we didn't have like many use cases for them before, but they are also catching up with blockchains, and they are like finding their great use cases in blockchains. For example, like zero knowledge, that it was just like theoretic, like the whole theoretic like and scientific papers that we had before, but now it's getting more practical. It's unlocking many new possibilities in blockchains, and maybe we can see much more creative applications created by these solid scientific papers that we've had and like grabbing them and actually using them in blockchain.
Thank you. Thank you, ladies. I think it's time for Q&A part of our conversations. We've got a few minutes, so we've got one coming up.
Hi, guys. Thanks for the info. Do you think that maybe a better metaphor for DAO tokens might be preferred stock or bonds rather than common stock? Because preferred stock might have different voting rights and there could be a liquidation preference. So maybe common stock puts people in the wrong frame of mind that it's purely the ability to vote and a percentage of profits in future venture or something.
I can take a first stab at that one. I think I don't get too caught up in the nomenclature. I really more look at the use case on a token by token basis, because lots of tokens can have different components to them. And I don't think that the regulators are looking at them as common stock versus preferred stock. I think they're looking at them as a security, which token, preferred, common are all securities, and they're all regulated as securities. So I don't think that that would make a big difference. I do find because I'm a securities lawyer, so when I have people coming to me wanting to set up a DAO in order to issue a token, it's because they want that token to not be considered a security. And that's where there's a bit of friction in terms of like, how do you actually set up a DAO? How does a group of people set up a decentralized organization that issues a token right off the bat that is sufficiently decentralized to not be a security? It's a very technical answer, but that's where the rubber hits the road.
Anyone else?
I couldn't agree more with how Julie's looking at it. From a doesn't actually really matter on the nomenclature. Is it a security or is it not a security? One day we'll move past that conversation, but not today.
I had another question about jurisdictions. So if you're, let's say, hypothetically in the software business, and it's easier to bring a case in Germany for copyright or intellectual property, might that play into what jurisdiction, or how do you figure out what jurisdiction, or should you pick the jurisdiction that's best for you based upon what law maybe you need to apply?
So there is a thing called jurisdiction shopping, but what you need to do first is figure out what's your use case, what's your long-term needs, and then kind of think about and customers. So once you kind of figure out those pieces, then you can look at what jurisdictions have rules that apply to you in a favorable manner. So for instance, I know of certain exchanges that have become like regulated in Gibraltar because of the UK links and the portability that provides. I know other ones that have been very happy to set up in Canada to start off with and then expand from, because that's where their customer base is, that's where their mind and management is. So those rules are going to apply to them no matter what jurisdiction they incorporate in. So they might as well just keep it all in one house. So it's quite contextual in terms of what the best jurisdiction is for what it is that you're trying to do.
Thank you. And I guess our last question comes from online, and it's directed at you, Julie. It says, if FTX were in your jurisdiction, what would be the status of A, FTX customer crypto balance, B, FTX token in the bankruptcy?
Well, I don't think that FTX in Canada would be treated very much differently than FTX in the Caymans or the States. I am not an insolvency lawyer, so I'm sure that the procedures change slightly, but I don't know if the outcome would really be that much different. And all I could say that if FTX were registered in Canada, there would have already been certain regulators would have been looking behind the scenes earlier and may have been able to issue spot earlier because of certain terms and conditions and due diligence and the process that you have to go through to become regulated. So I don't know if they were a regulated exchange in Canada, if this would have happened quite as it happened.
Thank you. Well, if there's, all right, one more.
Yeah, sorry for the late question. So I worked at crypto.com for over a year, doing R&D stuff and bridging as well, the cross-chain applications. This is a question for Niusha.
Yes.
Yeah, because I saw you guys as a TeleportDAO and didn't do a very thorough research on it, but I see that you guys are kind of bridge based. But we kind of see a lot of accidents about bridges, Harmony Bridge, and so on. But we do want to have a lot of applications about cross chains if we want to have a good, Web3 future. So do you expect bridging to be still the focus in the future, or do you think like some other technologies would, take over the bridging to be more secure?
Yeah, that's actually a very good question. So there are two different aspects that I can talk about here. The first one is that will bridging still be needed in future? And the other one would be like, how can we bridge two blockchains? So at the first one, I can say that either there are some ways that the future might happen. So we might have some multiple layer ones that in that case, these layer ones will need to interact with each other, and we will have different ecosystems that would need to get synced, or we might have some application that will want to work on these different layer ones. And the second scenario would be that we won't have many layer ones. We will have one main layer one, but many layer twos on top of them. In that case as well, we will need to make these layer twos interoperable with each other and with that layer one. So that's why I think in any case, we will definitely need bridges in future. Because these ecosystems cannot stay separate from each other forever. And about the second aspect is that how we can actually solve this problem and construct a bridge between two blockchains is that, so basically there are two main approaches to solve this problem. The first one is the validator-based solution. So that requires a centralized entity, a trusted third party that sits there and moves the data between two blockchains. It gets data from one blockchain, validates it, and puts it on the second blockchain. But the second approach is to do all these using code. So you can write a code that validates and verifies the data, and it's run on the blockchain. It's public. Everyone can check that. And in that case, everything will be done in a decentralized manner. That's our focus on Teleport, actually, to make this bridging fully trustless and fully decentralized, so that when users want to go from one blockchain to another, they won't need to trust a third party. So that's why I think bridges will stay relevant, and that's why I think this solution would be the best, which has the highest security, because you're absolutely right. You cannot, for example, when you want to use your Bitcoin in Ethereum ecosystem, you don't want to sacrifice its security by trusting to one person or one entity. So definitely you want to have the security of Bitcoin and Ethereum while moving from one blockchain to another. And that's our main focus here.
Thank you. Well, that wraps up our panel discussion. Ladies, Moshrefi, thanks for spending time today with us. All your thoughts, and thank you. So I have with me Masaki Besho, yes, from Bank of Japan. He is the head of FinTech Center, Payment Settlement Systems, and Carol House is the director of Cybersecurity, Secure Digital Innovation at White House National Security Council, and she comes from U.S. Treasury Financial Crimes Enforcement Network, and formerly an Army captain. Thank you both for being here today and spending time with us. Our topic of discussion is coordination between blockchain-based central finance and CBDCs. Obviously, we had some questions and comments about CBDCs earlier. But here we're going to drill down a little bit more into CBDCs. Now, as we put this panel together, we were in a little bit of conflict, I suppose, since CBDCs are not blockchains. So it goes against our grain. But we have to admit that from a use case perspective, they are the 800-pound gorilla if and when they show up. So we do have to address them. Hence the reason why we are addressing them. So without further ado, I'm going to start with Carol. Since you sit at very important place and see things from a different perspective, could you speak to a sort of a broad perspective from a national security sort of a viewpoint? Are CBDCs a threat, or are there a necessary arsenal? Take the example of the Chinese ECNI, Belt and Road, et cetera, et cetera. Would US want to be in the game or wants to be not in the game?
Yeah, it's a great question, especially building on a lot of the discussions that have happened so far related to privacy and what the future of regulation and decentralization looks like in these spaces. So first, I'll just caveat that I'm no longer with the National Security Council. I left government about 3 months ago now, actually, but I was honored to be a part of the work that the White House was driving with the interagency on all things digital assets, including the work under the president's executive order on ensuring responsible development of digital assets. So I think that really sets the stage and highlights my perspective about where I come at for central bank digital currencies, in the same way that any other types of digital assets need to be pursued really thoughtfully, deliberately, and with things like compliance, privacy, security, and market investor consumer protections and environmental considerations in mind. So do central bank digital currencies. That is inherently a part of it. There's so many different implementations and choices that can be made related to the technology, related to the governance. Lots of choices between like account or token-based management of the assets, or and that's also kind of a false dichotomy, as the Hamilton Project really pointed out, that there's lots of other different types of nuances and choices in how you can implement a CBDC. So I think first off, just recognizing that CBDCs can mean lots of different things. Like you mentioned, that they don't necessarily mean that they have to be blockchain based. They could, but they probably aren't public decentralized ledgers, although those are choices that central banks will make, but that's very unlikely to be implemented for so many different reasons. Of course, blockchains, and you can implement things on the full spectrum of decentralization. The choices typically aren't binary. It's not centralized or decentralized. It's how centralized, how decentralized. What are the roles of centralized intermediaries or not? What types of permissioned or unpermissioned access should be allowed into the ecosystem? All of those choices have to be made. So first, I just wanted to highlight up front that it's really, there's a lot of nuance to acknowledge in the space. The US definitely views that it already is in the CBDC space. I think we've seen that clearly from the Fed and from the White House, really driving a lot of initiatives related to central bank digital currencies. But I think it's totally fair to recognize that other countries are engaged in lots of pilots and research and development opportunities. And of course, some have already launched their own central bank digital currencies, whether in pilot form or actually already implementing it. So based on that, I really found that both industry and government bodies on either side, though there's lots of different perspectives about what that future of money really should look like, I think there was a welcome reaction and embracing of the fact that the administration was driving, and the president for the first time ever established as the highest, at the utmost priority, the fact that we needed to prioritize research and development into evaluating a US central bank digital currency, whether it's in our national interest, and then also to pursue research and development to be able to make sure that we can make informed choices about whether or not it is in fact in our interest, what those implementation choices and designs should be on the technology and governance side. I think that was really a welcome signal from the administration to so many people that were looking for the US to try to take a stronger role in emerging payments. So I think that's really critical. The US needs to play a role. given the broader context of central bank digital currencies, there's a lot that can really be at play to discuss whether or not certain CBDCs like the ECNY might pose a national security threat. Again, it's all about nuance and implementation and adoption. There's the potential that if if a certain country increases through their implementation of a CBDC, their importance in international trade, and can shift the share of global financial flows, and can leverage influence with partners to force that contracts are not denominated in their currency, in their CBDC, and that they have to accept it, then it's possible that could disrupt deals, could disrupt potential US dollar dominance, and could also try to drive more other currency or other CBDC denominated liabilities that would drive central banks to potentially reduce their holdings in US treasuries. I'm a little skeptical about the magnitude of that shift, especially for certain currencies like the ECNY, given huge concerns around their cybersecurity, around especially their privacy, rule of law issues that are at play there, and all the other things that really drive to why the US dollar is the predominant global currency and reserve currency right now. But so even though I'm skeptical about the magnitude of that shift for that particular currency, I also recognize that with more CBDCs and the need to hold liabilities denominated in other currencies, it's potential that even if one other one doesn't rise to displace the US dollar, it could ultimately just diminish the amount of US dollar that is held somewhere. So there's a lot of national security implications that could impact things like sanctions efficacy, anti-money laundering efficacy, just the broader privilege and benefits that the US gets from holding the US dollar as the predominant reserve currency globally. But hopefully that hits on a couple of different aspects, like pointing to the nuances, the fact that there's lots of different choices. There are some serious national security concerns that need to be considered. And I think that the United States government has highlighted that it has to be a priority. We'll see what comes out of the research and development agenda for digital assets that was announced earlier this summer.
Thank you. So that actually helps me to ask my next question. Besho, as someone who's been involved with BOJ, and especially in a country that relies heavily on international trade, looking across Asia, even all the way down to India, there are quite a lot of movements, friendly movements towards CBDCs and whatnot. Does that, affect how BOJ perceives, CBDCs in a positive way or not?
Thank you for having me today. And as Carol mentioned, we have a number of choices on CBDC. And for manager selection, CBDC will be a tool to introduce further efficiency and safety primarily for the domestic payment market. And the design or choices on CBDC are basically in line with this objective. And actually, we have two variants of CBDC, wholesale CBDC and retail CBDC. And the Bank of Japan is interested in both. But for this question, I'll focus on retail CBDC. And in Japan, first of all, it is not yet decided whether we'll issue CBDC or not. And it should be a national decision supported by the general public. Having said that, the environment surrounding us are rapidly changing. Digitalization of the society is accelerating, and also the market environment in the retail payments are changing. And in the future, it might be the case where the society requires us to issue a Japanese CBDC or digital yen, and we should be ready for that scenario. And in terms of technologies around CBDC, last year in April, we started proof of concept of CBDC, and it's phase one. We covered basic functions of CBDC, in focusing on ledger, including issuance and distribution via intermediaries, and transfer between users and redemption as a CBDC. And its phase 1 was successfully completed in March this year, and we stepped into its phase 2 this April, and we are now working on it. And in this phase, we are verifying some additional functions, including, for example, implications for the financial system, and also some interoperability with existing payment rails. And in terms of institutional arrangement of CBDC, our focus areas include, for example, allocation of roles and responsibility between the central bank and private sector, and implications for the financial stability and privacy and AML, and also technical standards and implications for cross-border interoperability, cost design, and also legal arrangement around CBDC. So we have a number of items to work on. And in carrying out these works, communication with various stakeholders is critical. Therefore, last year in March, we established the Liaison and Coordination Committee of CBDC, where we invited representatives from government ministries and also from the financial industry. And also discussion and sharing of experiences with colleagues of the other central banks is important. Therefore, we are actively working on G7's working group on payment technologies. And also, we are a member of the group of central banks where we are working with colleagues of major central banks, including, for example, US Fed or Bank of Canada.
Thank you. I guess before I open the floor for Q&A, Carol, since you mentioned something about the privacy issues, one of the things, first of all, I got to do a disclaimer. I love the notion of CBDCs. I think they're fantastic. I'm going to give you one example. When the sort of help loans were given to small businesses during COVID, there was no effective way of timely verification of where the money goes. During crisis, you want money to go towards economic activity, real economic activity. Not that it's widespread, but now we know that there has been quite a lot of unkosher usage of those funds. If you had a CBDC, programmable money, you could basically program what that money can be used for. So a business owner cannot buy a Lamborghini with a loan that is extended or a grant and extended, but it can only pay towards payrolls. Now, it is true that the opposite can also be true. That in case of ECNI, one of the concerns is that they can use it as a social engineering tool, that I can track everything you do, and hence there is no privacy. Albeit I'm one of those that believes privacy is just an over exaggerated notion. We have very little of it left in this world. But setting that aside, in your evaluation of where things go, how much of that programmability sort of a benefit weighs against all the other concerns, the sort of a privacy, et cetera, concerns?
I love that question, and also first really appreciate your point about loving CBDCs. I love really focused, deliberate initiatives to try to expand the research and development to assess whether or not we think that it's appropriate, that it's the best way for us to scale the speed and efficiency and all the other policy objectives for things like financial inclusion with payment systems. I'm open to the fact that it could be not a CBDC, but I also think that there's no way to make that choice without doing a really deliberate, focused effort on research and development, assessing, and pilots and cooperative efforts. So I think either way, CBDCs have to be really thoroughly assessed, and the U.S. has to have a significant seat at that table. And that really, again, now points to the purpose of programmability. That's the great thing about all of these assets, right? You can program them in. Part of the message that regulators were constantly communicating out to the sector was that you're right, it's programmable. kind of like you can program in things like compliance potentially into the ecosystem. The great thing about software, it will do exactly and only what you design it to do. So I think there's a lot of really fantastic opportunities to leverage that programmability that you spoke to be able to achieve some of the objectives that we want around integrating things like digital identity, as well as things like privacy into these ecosystems in a way that even the sector really was not open to considering or having a conversation around several years ago, and that now there are huge new businesses and initiatives that are being stood up specifically to solve this issue. So I am very encouraged by some of those efforts, while still acknowledging that there's huge problems that still exist. But I think that there's a lot of great potential for industry and government to help generate the technologies and drive what those programmable choices, which have implications for tech and governance and roles and responsibilities, to get that right, and choices that have to be made about where some of those objectives get built in. What type of programmability do you expect at the protocol level versus at the network layer with validators and miners versus at the application layer, at the market layer with governance bodies. I know DAOs and others were discussed previously, but all of those, there's different choices that have to be accounted for, including specifically with privacy at each of those layers. So I think that it has to be accounted for. There are really great benefits that can be brought in. You mentioned challenges with COVID fraud. That was a major focus of the White House, and we actually announced an identity executive order this past spring that's currently still under development, related to trying to combat identity theft and fraud in those federal benefits programs and pandemic relief programs. All of that, the great benefits that you have for programmable money that can give direct economic stimulus to those that need it, and to potentially track things. So the government loves some of that, and consumers love and hate some of those features that we talked about. So I think the most critical piece about privacy that I know I've said in other forums before is that privacy does not mean anonymity. Privacy means that there is data somewhere that is discoverable, disclosable, usable under certain conditions, permissions, and protections. So it's really just those choices that have to be assessed and made on, and the implications then for things like disintermediation and intermediaries, including some intermediaries that already exist in these ecosystems that may not be regulated, but are still intermediaries. A lot of choices have to be made around what data should or must be visible and disclosable by whom, to government authorities, to industry authorities and intermediaries that are regulated for different purposes, what users should be able to see to facilitate things like consumer awareness and investor protections. All of those will have to be considered, I think, in digital asset ecosystems more generally, but also certainly with the compounded complexity in the US for central bank digital currencies that Americans really don't love giving a lot of data to the government. So I think choices that have to be made to make something technologically accomplish what we want it to, but then also a massive messaging issue will have to, a massive messaging initiative will have to occur to convince Americans that whatever those privacy features are real and are defended, representing those democratic values that I spoke to earlier, why the US needs to play a leading role in standards and pilot programs internationally.
Thank you. Thank you. For the sake of time, we have about 5 minutes left, so I'm going to open the floor for Q&A. There's one over there.
Thanks. This is a question for Carol. Maybe, I guess it's speculative, right? So spilled a glass of water on myself. Okay, so please excuse me while I move away. I have a question, I guess, right now, people can freely hold US dollars, right, as banknotes around the world. And you can imagine with a CBDC, whether the same to be the case. It's not exactly the same as holding banknotes, right? Now people outside the US can do new things in ways that are much faster than you could with banknotes. So, for example, you can have entire payment systems effectively based on US dollars outside the US, which is much more efficient than, say, using banknotes. And that, you can imagine, would have this effect of potential dollarization at a much faster rate than banknotes. Do you know if that's part of the work, part of the research work that's going on as part of this, or and are there any concerns about that? Because I'm sure there are concerns, especially in smaller nations outside the US.
I certainly think so. I think there's a lot of research and consideration that's happening certainly across different parts of the Fed, whether you mean different branches or also what the board is looking at, and of course in the U.S. Treasury, considering what that interplay is of the future of money, and what so that means realistically assessing the current state of what types of instruments are held and where by whom and why, and then what would now the insertion of this of a U.S. central bank digital currency potentially do, and how would all of those things interplay? What would be incentivized for amounts of reserves to be changed, how liabilities would be issued, and I think that that's definitely a huge focus on part of the Fed. I'd probably end up deferring to them based on them doing a huge amount of work and publishing some of their findings, but I do think that's a key area of focus for them. I just don't know that there's any final determinations or even any with certain levels of like confidence assessments, projections about definitely like this is the direction that a U.S. central bank digital currency would sort of drive things, because really it all of that R&D work is still quite nascent.
Thank you.
Well, I guess we could extend the same question to Masaki. I mean, Japanese yen has been a source of financial and economic development in Asia for sure. Would initiation of a wholesale, at least CBDC, make it easier for Japanese tech to continue to be a source of good for Asia and the world, or not?
Yeah, actually, for the question on currency substitution, yeah, certainly, that should be a factor which should be considered in designing CBDC. But even before considering that, we should design CBDC not to impair the financial intermediation in the domestic context. So in the phase 2 of proof of concept, we're designing some kind of safeguards to mitigate the impact to the financial system, where, for example, caps for holdings or caps for transaction values, or some interest rates which are unfavorable for the CBDC holders, or fees for transactions. So at this moment, we have not made any decision how we will design safeguards in our CBDC, but we should carefully consider the impact for the domestic financial system as well as the foreign financial system. And one of the 3 principles of the report of the CBDC group published in year 2021 in October was no harm to financial monetary stability, and that is a very important point. And for about the potential of wholesale CBDC, I think there are 2 kinds of primary use cases for wholesale CBDC. The first use case is bringing further efficiency into the cross-border interbank settlement, and secondly, atomic payment with the settlement of digital assets which are traded on DLT platforms. And for about the first primary use case, cross-border efficiency, that is a very interesting idea, but I don't think it is inherent to CBDC nor a DLT platform. The core element of that innovation is expansion of access policy of central bank reserves to the entities which are not domiciled or licensed in our home jurisdiction. And of course, that will bring further efficiency for the cross-currency settlement of payments but at the same time, we should carefully consider its implications for the financial stability and also monetary policy implementation. And the second point of innovation would be bringing 24/7 operation, which enables easier and faster cross-currency settlements. But even with the current RTGS system, it is doable to carry out near 24/7 operation. What is more challenging is how we could engage financial institutions for these 24/7 operations, which requires changes to their operational framework.
Thank you. Thank you. Thank you both. I think we're about ready. Both of you, thank you for your time, for your thoughts. I know I've asked quite a few loaded questions, and I am extremely thankful for your candid response. And I'm sure that all of our audience appreciate your responses to their questions as well. And with that, I think we're done for today. Thank you all.